Welcome to the West Business Development Center. We are a nonprofit funded by the Small Business Administration. We are both a women's business center and small business development center for Mendocino and Lake County. We provide free one-on-one counseling, webinars, loan packages, and advising to small business owners and entrepreneurs at every stage of business development. Our pool of expert advisors cover almost every area from permitting to HR and e-commerce. If you'd like to learn more about becoming a West client, please visit our website or give our office a call. There we go. This is our disclaimer. Yeah. You can read this in more detail on our website at www.westcenter.org. Next slide.
Attorneys got to get involved.
There you go. So now let's get started. Welcome to Money Management in 2022. Be ready. My name is Kelly Geiser, and I'm the event coordinator at West Center. Now, to pass things off, here's our amazing instructor, Joe Radola.
Oh, thank you very much. That's great. Oh, look at that. That picture looks just like me in the little box. Welcome, everybody. And is it afternoon? We made it to afternoon this wonderful Thursday. My name is Joe Radola. I'm the lead advisor for the Shasta Cascade SBDC and advisor for West Center as well. I've been teaching now, as you can see, for many, many years. I've owned my own small service business. So it's now my 11th year. My, how time flies. And my background's basically credit. So I'm a numbers guy. Isn't that great? So it's good to teach a numbers class because a numbers guy should teach a numbers class, right? In fact, back in the late, way back when we were using Abacus. No, we weren't using Abacus, but we didn't have computers yet, I'll tell you. Back in the late 60s, I went to college as a math major. So there you go. That tells you something. I worked for a commercial bank, director of a nonprofit consumer credit group that helped people get out of debt for 13 years. And I've been working with small business as a small business advisor for several companies for the last 9 years for nonprofit. So today, what are we going to do? It's 2022, gang. How about that? It just snuck right in there, didn't it? In fact, the first 2 weeks are about to be done already. So the objective of this class is to manage your small business's money, okay? Because money makes the world go round. There's all sorts of sayings attached to that particular statement. So we got to teach you how to watch, use, analyze your financial statements, the numbers that you prepare either on QuickBooks, maybe you use an Excel spreadsheet, maybe you have an accountant, maybe you have a CPA, maybe you have a bookkeeper, and they produce all these numbers, right? So hopefully by the end of this next hour, you will learn some of the ways to use those numbers to your benefit and prepare for tax time. Hate to say it, but yeah, it's right around the corner again, isn't it? April going to be here before you know it. So we're going to talk about the financial reports, understand their purposes, customize those for your needs specifically in your business. Each business is different. Use the information to make important decisions other than just, gee, I'm making money or I'm not making money. And learn about the language. One of the things that as a banker, my old hat, put the old hat on, don't have much hair left, but I put the hat on, is there's a language in lending. And we use all these buzz phrases, and we use all these acronyms, SBDC, here's a prime example, Small Business Development Center, right? What do they mean? So we're going to talk about, before we're done in the next, let's say 45 minutes or so, we get about 45 minutes in, we're going to start talking about ratios. And the banks and the financial institution, anybody that's going to make a decision on giving you money for your business to buy a piece of equipment, expand, whatever it might, buy a building, whatever it might be, uses these ratios of your financial position to make the decision, okay? They also check your credit. Another class we teach is about credit and the importance of keeping your credit in good shape. That's an important piece. But the financial statements, the numbers, the profit and loss, the balance sheet, that's make or break if you want to borrow money. It is. I mean, Without those being correct and showing some nice positive numbers, the banks, financial institutions, especially in this environment we're in now, with the end of the COVID thing, or we're hoping the end of the COVID thing, hugely important that those numbers make sense and are showing what your business is truly doing, okay? So understanding the numbers, real quickly, numbers matter everywhere, right? And I'm an old sports guy. I'll have to tell you, I have to admit that they called me a jock back in the day, right? So I went to high school basically to play sports and keep my grades up so I could play sports. So there you go. So in sports and recreation, number 9? So there's 9 innings in a baseball game, especially a professional baseball game. The number 1, first place, right? Number 1, 300. That's a perfect game in bowling. So as you can see, those are important numbers to anyone who likes various types of sports as an analogy. Kind of think of your financial statements and reports as your report card. It's your small business's report card. And I remember having to take those home and have my parents sign it back in the old days. Right? We used to get paper ones back when I went to school. We had paper report cards, and you had to take it in and have the parents take a peek at it. Sometimes you were happy, sometimes you weren't. Same thing with your financial statements, okay? It's your report card for your business. Why are they necessary? Obviously to make money, show the health of your business, pay your taxes, like we're going to say, April's coming around the corner, and cash flow, enough cash, okay, to operate. Sources of financial statements, basically everything's an account, okay? Everything is an account. I took accounting back in college, and accounting back in college, you had a debit sheet and a credit sheet, and everything had to balance, okay? Debits equal credits, okay? So if you had money coming in and you spend it, you'd have the money going out, you'd tally the numbers, anything left would then be an indication of a profit, okay, of a profit. So selling something, paying a phone bill, buying something, that's going to have financial effects. There are 5 types of accounts in basic accounting for a business. There's assets, liabilities, capital, revenue, and expenses. Those are kind of the 5 main, okay? Common financial statements, really the top 2 is what I'm going to talk about a lot today. The balance sheet and the profit and loss. If you're a small service business like I am, I operate out of my house. A lot of people do that, right? They have a house, they have a second bedroom. That's where my laptop's set up. So I operate my credit repair business, my credit repair assisting business out of that bedroom. So what do I have as asset? Well, I guess maybe my computer, but I use it for other stuff. So I don't really count it as the asset of the business. But if I had equipment, a bulldozer, if I was, in construction, if I had a bunch of mowers and weed whackers and blowers, if I was doing lawn maintenance, all of that would be considered equipment or an asset. And if I owed money on that equipment, that would be a liability, okay? And then, of course, the profit and loss statement, how much I bring in, how much it costs me to bring that money in, is there anything left? On small service businesses, the anything left normally is what we get to keep, right, and use, hopefully. That's the theory. Then, of course, there's break-even analysis. Mostly you want to do that if you're a startup. And then, of course, there's cash flow. And don't get cash flow and profits mixed up. They're not the same. Okay, we'll talk about that more later. Start with the balance sheet. What does a balance sheet do? Well, first of all, it balances, right? Assets equals liabilities and equity. We'll show you in a minute graphically. It's a financial snapshot. It shows the state of financial health of the company at that moment as a snapshot. It's what the company owns Cash, accounts receivable is money that you have billed for but haven't been paid. The value of that equipment, maybe you have software that has a value. Okay, those are the assets. That's the good stuff, right? That's what you own. Liabilities are what you owe. Okay, so what the company owes. You're going to have bills to vendors. Maybe you have loans on the equipment. Maybe you have a mortgage on the building that you've already reported a value of on the other side. Maybe you have some taxes that you owe as well. You haven't paid them yet. That's called accrued taxes. So that's your liabilities, or the negative side. And then what's left over, hopefully that's a positive, right? That is what the company owns minus what the company owes, shows what the value is, okay? Shows what the equity in the business. Your profits from year to year flow into the balance sheet, okay? Flow into the balance sheet. There's another class that I teach for sole proprietorships on this very subject to show you how a small service business can still have a balance sheet, okay? The sum of owner's equity is either money invested by you as the owner, retained earnings, okay, profit and losses from the to date from the P&L, and of course minus your owner's draw as you take money out. That's theoretically how you show amount of monies that you have pulled from the business. So here's a balance sheet, kind of a summary for a company, okay? So this side of the equation, you got your cash. You have $100 in a little box in the drawer for incidentals. You've got accounts receivable of $40,000, which means you got a lot of billed out, but you haven't received that money yet. You have inventory. So this is a retail, they're selling retail products, this company. So they have an inventory. They have some supplies, prepaid insurance. So their total current assets, the assets that are readily available, $79,000 in this case, okay? Then you have the fixed assets, and those are things that you can't move quick. Land, buildings, equipment. You're probably not going to move it anyway. It keeps your business open. So you have land, you have the improvements, you have a building, you have equipment. Those are the values of those. And depreciation. Depreciation is the likelihood of that equipment that you might have, you get to write off as it drops in value year by year. There's an accounting rule that's followed for that. I'm not an accountant, but if there's an accounting rule that says, you know, if you have a piece of equipment, in 8 years, it should depreciate out completely. Okay, that's the theory, whatever that number is. So total fixed assets for this company, $337,000, including the building and equipment. This company has goodwill and trade names. Goodwill trade names, Aflac Duck, Geico Gecko, McDonald's Arches, you name it. Those are all value items, okay? Those are either trade names, trademarks, and then goodwill itself. Goodwill is just simply, gee whiz. You want a quick, cheap meal, you know, it doesn't have a lot of bells and whistles. You go to McDonald's and grab a good old PLB, right? The puny little burger, and you know, pay $1, $1.50, whatever it is, and away you go. So those are all goodwill and intangibles. I don't have any of that in my business. It's just me, right? So the total assets is $721,000 in this particular case for this company. Then you look at the other side. Accounts payable, wages owed, taxes payable. So those are all things that have to be paid currently. 50 grand, 50,500. That's the leftover amounts of the notes or loans you have outstanding on these assets and the money you owe on the equipment still. So the long-term liabilities or expenses eventually to be paid, 170,000. So total liabilities, 220,500. Okay. So the equity in the business is the difference between 721 and 220,500. Okay. If you do the math, it's 500,500. These guys have stock, retained earnings, common stock. Most of us won't have stock. We'll just have retained earnings. 9 times out of 10. And could be owner draw will come out of the owner's equity side, okay? But as you can see, both sides must balance. That's why it's called a balance sheet. So the grand total of owner equity and total liabilities is 721, and so are all the assets, 721. Pretty clean, huh? All assets are listed in order of liquidity, and liquidity just means simply how quickly can it be turned into cash. Cash, of course, is cash. That's always number one, right? You turn it over and get rid of it, you can spend it. If you have marketable securities, if you have accounts receivable that's owed to you payable within 30 days, you have inventory, you have stock, supplies, stock supplies. If you're selling this pen, you'll have a bunch of pens, right? That's your inventory. Okay, you can sell them. And prepaid expenses if you've already taken care of those expenses. Okay, that's your assets. And the fixed assets we talked about, right? Building equipment, depreciation on the equipment. Those are things that aren't cash. Okay, you have to sell them. Takes a while. Takes longer. Current liabilities, stuff you have to pay within 12 months or a business cycle. Normally it's a calendar year. Most of us run on calendar year, right? So calendar year, that's accounts payable. That's your technically accounts payable could be what you buy on your inventory, right? Your inventory that you buy. Current portion of long-term debt, which would be the next 12 months worth of payments like on your building. If you owe on revolving credit cards, if you owe payroll, okay, and if you owe taxes. Those are things that have to be paid within a certain amount of time, normally 12 months max. Long-term liabilities, the rest of the mortgage, the rest of the equipment loan debt, okay? Long-term, it's called long-term liabilities. And retained earnings, again, is whatever's left, right? And hopefully it's a positive, should be. Theoretically, should be a positive. Okay, that's what it should be. That's why we always suggest that if you're an ongoing business, you want to show a positive balance sheet, don't pull all the money out and spend it. Leave some into the business. People talk about leave it in the business a little bit. That's what they're referring to. Leave it in the business. Called retained earnings. Okay, any questions at this point that may be important?
No, Joe, nothing at the moment.
I think somebody had mentioned, will they get the slides? You normally send them out, right? Correct?
Yes. Correct. Yes,
Yeah.
we will be sending the recording out.
You don't have to memorize anything. How good is that? We're not keep it from you. So you'll get a survey at the end, of course, to tell us how you like what we're talking about as well, but you'll get a copy of these slides, hugely important. So that was the balance sheet. Now we're going to talk about the income statement or P&L. A lot of people, there's your acronym, first acronym, big acronym, right? P&L, profit and loss. And that's one of the things that bankers, financial people, your mother-in-law, your dad, your grandpa, anybody that's going to invest in your business, they'll probably want to see that. Right? Why? Well, they want to make sure you're making money. If you're continually showing negative losses, chances are you're not going to be able to borrow anything, right? So there's the deal. That's why the P&L is so important. So the P&L, profit and loss, basically the income statement, profit and loss, it's what you bring in minus what you spend equals net profit. That also becomes how much you pay taxes on for most of us. If you're a sole prop, a partnership, that bottom number, net profit, that's what you pay your taxes on. Okay, not how much you bring in, not your sales. No, it's what's the bottom. They call it the bottom line. A lot of times you hear people call it about bottom line. Well, that's the bottom line. It's net profit. And that's what you pay tax on, okay? So the income statement, the basic structure of the income statement is the same for all businesses. However, it depends on, For instance, I have very little accounts receivable. Technically, as of today, Thursday, January 13th, I have 2 bills out for the month of January. So that would or could be considered, and I consider it as accounts receivable. Okay. I perform the task. It's done. It was done earlier this week, and I've billed for that time. Okay, I billed for that time. So that becomes accounts receivable, and normally I have it set now over the years that I get paid that money by the end of the month in which I do the service. So I mark my little calendar in my head or on my little Gmail calendar that says, if I don't get the money by the 27th, I start going, start asking questions. So that's accounts receivable. Not everybody's got that. If you're selling retail product to somebody walking in your store, you won't have accounts receivable. Okay. I buy that pen that you paid $1 for, and I pay you $2 for the pen, and I walk out. Well, you got my $2. You already paid $1 to buy it, so you got a dollar gross profit. You got the expenses, but you get the idea, right? Pretty cool. So here's a nice little income statement for a company. They put this widget company in the thousands. So that first number there, the widget sales, is like 4,125,000, but we take the zeros off. So basically they got the widget sales, they sell repair kits for the widgets, and they perform service for the widgets. So that's their total revenue in 2009 is the 5,711. So if that's 5,711,000. Sales costs or total cost of goods sold. Aha, there's a new bit of information, right? As a service business, technically, I don't count cost of goods sold. I could, I suppose, if I put a value on my time. Technically, what I do with the time is that's Joe's money. See? So service businesses are pretty simple, right? You charge for the service, you pay for all the little expenses, anything left is Joe's money. There you go. So that's your cost of goods. But if you're selling a retail product, or you're making a widget in this case, you may have raw materials to make the widgets. You may have expenses to buy or set up the repair kits. And you may have expenses or total costs for the service side for parts. So as you can see, their total cost of sales or cost of goods, however you want to put it, is 3,411. So you got to take that out of your total gross sales because you didn't really make that. You only made $2,300,000 at this point in gross profit, just based on what you're doing for a living, right? Your widget sales. Then you got the gross. Then you have operating expenses, right? You got to pay for the lights. You got to pay for research. You got to, pay your staff. Whatever it is. So you've got all sorts of expenses on the operating side. Okay, so there's another 1,000,009. So now your operating income's down to 400,000. See, and then you prepaid some interest. Interest paid. There's another bit off. So now you're down to 399,000. You have to pay some taxes. Now you're down to 272. So the bottom line of this widget company is $272,000 after everything's said and done for the year of 2009. That's how much they made profit. Okay, net income, net profit. Okay, pretty easy to follow. Not too bad. Okay. So the income statement, again, it's income derived from sales, okay, or whatever it is that you're doing. Like in my case, I teach classes and get paid for it. So when I teach a class and get paid for it, that's a sale. That's my sales, okay? I should probably start selling my video. I should tape all my classes and sell them. Oh, There's a cool idea. I never thought of that. This day and age, that's a way to go, isn't it? Got to add that to my website. Anyway, so so selling, okay? This should be income from normal operations. In other words, you would not put this as income if you sold a piece of equipment to somebody. That's not sales. That's sale of equipment. So it's reported somewhere else, okay? Not here. Net income is derived by taking the income and subtracting, of course, returns, discounts, and cost of goods. That's a very important piece if you're doing retail, especially, or even manufacturing and retail. So there's your cost of goods. Method of calculating, it's called COGS. So you'll hear that term used, COGS. There's another acronym, okay? Cost of goods sold. And that's normally, like in this case, I was talking about the pen, right? If you buy these in bulk for 50 cents, so you buy a whole bunch of these, you put $5,000 worth of pens, okay? That's how much your expense was, your cost of goods. Then you sell them for $1 a piece. So your net profit's the difference between what you've collected for each pen minus that cost of goods in buying that pen, okay? Cost of goods. And that gives you then a gross profit, right? Because it's not all the expenses are out yet. Okay, so then you got all the other expenses, right? You got your lights, your rent, your office supply, payroll, utilities, all those still got to come out. That's normally called operating expenses, by the way. Okay, that's to do business. Okay, so you got operating profit, net profit, and again, net profit's the bottom line. That's the number. Okay, I'll give you a warning. I'll give you an early warning right now. When I was in banking, I was a bank manager, and people would come in, and I'd get to know people in my office. And clients would come in, customers, and say, "Hey, Joe, what a year I had. I sold $1 million worth of stuff." Okay. I said, "Hey, that's, this was like 30 years ago. So do the math." Every once in a while, you want to go online and say, what is $1 million worth today from 1970? You'd be shocked. Anyway, so the guy goes, "Yeah, I sold $1 million worth of stuff." And then, of course, I'd congratulate that person. And right afterwards, being the banker I was, I'd say, "How much did you make?" "Oh, well, I didn't make anything. I don't want to report any profit to the IRS, then I got to pay taxes." And then I give out the warning I always gave out, and that is, "Oh, so you really are saying you have nothing left after selling that $1 million? So if you want to buy that new piece of equipment that you've been talking about and you want to come in and get a loan, how are you going to pay for it?" "Well, So there's the tale of warning, is to not write off everything, okay? You got to be able to show that the business is making some moolah, especially if you want to expand. Now, if you don't want to borrow any money, great, get it down legally to as close to zero as possible. That's fine. That's a thing you do in business all the time. Why would you want to pay, more than you really should in taxes? But don't wipe it all out if you want to borrow money, because you're not going to be able to do it. Not going to be able to do it. Okay. So there's my little tale of woe. So again, income statement, profits are not to be confused with cash. Let's be real clear on that. Profits are not cash, right? We already talked about that. Depreciation is funny money. It's not really money. It's not cash. Depreciation is writing off a piece of equipment because you used it for a year. Okay? It's value that you've lost, not cash. So depreciation isn't cash. So it's not the same. Okay? I got to change that. It says profits equals cash flow. That's the one I got to change. Let me do that. I'm going to write that down as a note real quick. That should have an X through the equal sign, guys. Sorry about that. Somebody warned me about this last time, and guess what? Joe didn't catch it. I'm going to fire myself. So slide in class. I'll change that. They should say profits don't equal cash flow. Okay, profits don't equal cash flow. I blew that one. It's okay. Now you got what I'm talking about, right? Because I actually corrected myself. Okay, the effects of profits can be seen, of course, on the balance sheet. Profits flow to the balance sheet as retained earnings. So whatever's left in that P&L at the bottom, that net profit, goes over into retained earnings on the balance sheet, right? So retained earnings, as it collects over time, is what shows that your business is motating the right direction, okay? It's showing it's viable. If retained earnings stays stagnant and very small, you're not making a whole bunch of money. There's some real questions as to whether or not it's going to be viable on a continuing basis, right? So retained earnings as it grows on that balance sheet, hugely important to verify that your business is doing good, doing well. Effects of losses, of course, can be seen on the balance sheet as well. Losses flow to the balance sheet as decreased retained earnings. So if you had a year, say 2020, let's use 2020 as an example. Due to closures forced upon us, many of us could not make as much money in 2020 as we did in 2019, right? That's not rocket science. It's just that we were closed. People couldn't go anywhere. People weren't buying much. If you didn't sell opportunities online, if it was just, walk in and purchase stuff or classes, teaching classes, very difficult until we figured out this Zoom thing. I was telling Kelly, what a difference, huh? 2 years ago, I didn't know this thing existed. I'll tell you the truth. We did very little Zoom stuff. Skype, Zoom, whatever you wanted to use. There's what is it? Something, go to meetings. Yeah, that didn't, now it's done all the time. Isn't that crazy? So, yeah. Income statement, P&L, putting it all together. So the income statement is a picture of how management makes decisions and how to price product. That's the other thing you can do. It's obvious now in our situation, in the economy we're experiencing today. And by the way, I remember the 80s, the last time inflation went. That was a big one then too. And by the way, in the early 80s, that never did drop back. People who watch you say, oh yeah, it's going to go back. It's going to go back. I'm not counting chickens on that one, okay? Because it didn't in the 80s. It did not drop back, but we're seeing that massive inflation again. So if you charge $10, well, I'll give you a prime example of going out to dinner or going out to eat. We have a local hamburger stand here. They're fantastic. Shameless plug. Place called Dam Burger. Okay. Dam Burger up here in Reading was started when the dam was built back in the 1930s and 40s. Isn't that cool? Some young person said, hey, these guys need food. So he took his trailer out there and made hamburgers at the dam, Shasta Dam. Isn't that cool? Those of you who houseboat up here know what I'm talking about. That's that big dam, right? So Dam Burger. The price of their burgers have gone up. The rolls, the mustard, the ketchup, everything's gone up. So guess what? You got to raise the prices, don't you? Otherwise, your margin is shrinking. So now I go once a week. I spoil myself. Don't tell my doctor. I spoil myself and go get a Dam Burger. Eat my historical company, locally owned Dam Burger here. But it's gone up in price because their margins have been tightened because their raw materials have gone sky high. All right. So that's another thing you can do with these income statements and profit and loss is decide wow, man, I'm selling the same amount, but I'm not making any money. May have to raise prices, huh? Right? So this helps you make those decisions as well. Any questions before we get into the ratio piece? Let's see, what do we got here? Feedback.
No new questions, Joe.
Cool. Thank you. So now I get to teach you what the banks and financial people look for. Okay. This is a little, you always wonder why you went to school and learned division, multiplication, and ratios. This is why, right here. Okay. It's not trigonometry. It's not geometry. So it's not that wild. But you got to know how to divide what numbers to come up with these financial ratios that the bankers look at. Okay. We'll start by financial ratios. This is called the secrets revealed. So as a banker, we always talk about how quickly you can convert your sales into cash and how much cash you got left at the bottom line. Okay. So let's talk about the first three ratios. Working capital, current ratio, and quick ratio. Those are the three easiest to develop ratios, okay? Start with working capital. And that's why you need balance sheets, by the way, because the balance sheets do a lot of these calculations for these ratios. So working capital is your current assets, your liquid money, minus your current debt or current liabilities, okay? This tells if you have enough money to pay for your current debts, especially if things get tight, okay? If the number's negative, in other words, you owe more currently than you have in ready cash, that can get nerve-wracking. That can get nerve-wracking. A lot of people had that happen in 2020 and 21. That's why the government came up with all these programs. Hopefully some of you, if you are in business for yourselves already, were able to take advantage of the EIDL disaster loan for the COVID relief, maybe the Paycheck Protection Program loan. That's why those were developed. Why? Because your income flow was shrinking because you were closed, but your expenses stayed the same. So, yeah, see, you weren't able to make the payments. None of you, we all had problems. So that's working capital, okay? Should be a positive number. Current ratio, the same numbers, your current assets divided by current liabilities. It's called a current ratio. And it only makes sense if you're a numbers person that it should be greater than 1. The higher it is above 1, the better, in my opinion, okay? In other words, if you got a whole ton of cash and your current liabilities are relatively small, you could have a 2-to-1 ratio, couldn't you? See, because you got all this in case something happens. And in this day and age, with this COVID mess that we're experiencing, always nice to have a little more in the bank in case something happens, because we don't know. We don't know, do we? Yeah. So current ratio, and again, these are looked at, they've always been looked at it the same way. It's a little tighter now because of COVID, let's be real, okay? I've kept in touch with all my banker buddies that are still working and not fully retired, and I keep in touch with them, and they're saying, hey, Joe, it's, remember 2009 when the real estate market fell and everybody went, it's right, it's pretty close to that, if not right there, because small businesses right now are still having a hard time getting employees, getting product, getting the right mix of mask, no mask, and you name it, it's a problem. So it's tough right now, but they still do these calculations. And then the quick ratio is what we call the acid test to determine if you have enough working capital to meet needs after you remove inventory from the equation. So inventory Inventory's not, it's included in your current assets, but guess what? If I had 5,000 of these pens, how quick can I sell them if I went out of business? I don't know. Can you return them to the guy that made them? Don't know. So inventory is not as liquid as we would all like to think. So that's what they do, is they subtract that out and prepare a quick ratio. And again, should be as close to one as possible. It's better if it's one completely. Kelly's there. Do you have something for me?
We got a couple questions in.
Cool.
Karen Lewis asked, is a current liability 1 month's accounts payable or question mark?
A current liability in that category is any bill that could be paid in a 12-month period. Normally 12-month period. So yeah,
And
12 payments. So if you had a payment for rent, you could put those 12 payments for rent in that category.
we also had a Tammy Chandler. She asked, is property value versus mortgage or debts included as an asset in working capital financial ratio?
So yeah, your asset side would be your value of the building, right? My guess theoretically, especially in California, if you own a building in California, your asset value from 2019 to 2022 has gone up. We just had a report this morning up here that we have one of the lowest amount, this is homes though, lowest amount of homes for sale currently in our county than we've had in the last 15 years, including before the last economy fell. And I'm going, oh, supply and demand, supply and demand. You know, that whole adage, right? So right now, business property is worth a ton. So that's the other thing. You want to check and see what the value of that property is. But yes, you count that current property's value, and then you owe something on it. Okay, so that difference then would be your asset value, net asset value. Okay, and some ratios include that. Let's go to the next page. I think these ratios are all based on cash flow here. Okay.
Really quick, Joe, one last question, not quite about ratios, but Jenny previously asked, is it important to enter all your receipts for each quarterly tax session to only pay your taxes on your profit, or will it even out at the end of the year?
It's best to pay it quarterly, and I'll tell you why. I'm not an accounting person, but I know a little bit about accounting, so I'm gonna have to preface this with check with your accountant, CPA, bookkeeper. But here's the rule. If you don't pay enough prepaid tax during the year, I pay quarterlies. They call it quarterlies. I pay your quarterlies. What that means is I toss $500 a quarter to the IRS under my EIN, my tax ID number, right? So I throw them $500. What that means is I prepaid for my taxes, haven't I? And if I don't pay, I can't remember if it's 70%, 50%. There's a percentage. If you don't pay it, there's a fine. I don't like to pay the fine. I did it twice in the last 11 years because I didn't put enough quarterlies in, right, to cover the fine difference. Really upset me. And I think the fine's like, I don't know, it started at 100, it's probably 200 now, maybe more. That's like throwing money in the street. You know, $200, I can buy a lot of something, whatever it is. Damn burgers, I buy a lot of damn burgers. So yeah, paying quarterlies is a great idea. And if you have a CPA, an accountant, anybody you use, and you can even print them off the IRS website. There's a little form. It's a quarterly slip. You put your tax ID number, name of the business, you know, your address, all that pertinent data on there. You slip a check in the mail, ship it out to them. Ship it out to them. They got the address and everything. I think it's North Dakota, South Dakota. I don't know, one of the processing centers in the West. And you're prepaying tax. So I always suggest you do that because you don't want to pay the fine. Why pay a fine? Okay. Okay, so financial ratios, number 2 large. Let's see what we're talking about. Oh yeah, we skipped that. Let's do that. we jumped too far. My finger got too quick. So, all right, so there was that one. Okay, so leverage ratios tell us how we're paying for our assets, okay, the things we own. It's called a debt to equity ratio. The debt to equity ratio shows the total liabilities that you have in your business divided by the owner's equity. A number that's too high means that the business is using too much debt to finance the business, okay? If it's reversed, you may be using too much money. And by the way, we can help you at the West Business Development Center to identify your business's numbers for you. When you get your finalized paperwork from your CPA or you finalize your QuickBooks and you press the button and you go, well, there's 2021, baby, it's all there. And you want us to help you identify these ratios. You got me, you got Steve, you got a couple of other people that can help you for free identify what yours look like before you go to the bank. How about that? So in other words, you'll know all these numbers prior to going in and asking for dough. And we don't charge you anything. How about that? Because it's paid for by our tax dollars already. And that's where the rubber meets the road, as I say. I can tell you all about these things, fine. If you're really good at math and you want to go ahead and play with them, go for it. But if you just want to say, that's, math, my youngest daughter, she doesn't know math. I help her with it all the time. She's not a math whiz. She can write anything you want. She can write for you, but math, nah. So if you want to find out about these ratios for your business, sign up for services through West and say, hey, I need somebody to help me analyze my financials because I want to go borrow money for whatever it is. Boy, I'll tell you what, we'll do her. We dig that. We dig, because there's a lot of ex-bankers working in these positions, let me tell you. Then we got profitability ratios. Tells us how effective a business is at converting assets into profits, okay? So sales, gross profit margin is your gross profit divided by sales. Number too low indicates that the cost of goods are too high and the amount of revenue remaining and the expenses are too small. So the goal is 0.5 or higher. Again, there's a math number, right? The ratio is 0.5. What this would indicate is what we just talked about. In other words, your prices have gone up to buy your raw materials or your inventory, but you haven't raised your prices. So guess what happens to gross profit margin? It shrinks, right? And you can tell it probably just by looking at maybe one or two pieces of, whatever it is. You say, holy smoke, I used to pay 50 cents a piece for these pens. Now I'm paying 75 cents. So do you pass on that increase to your client? Do you eat it? Do you pass on part of it by raising price? Ha ha. And that's one of the decision-making factors. And then there's profit margin, which is net profits divided by sales. So basically you're taking it down another step. The goal on the profit margin is to be positive number. It could be positive 0.01, doesn't really matter. You just don't want it to be negative. And each industry, it varies. So if you're a manufacturer, it'll be different than a retailer, will be different than a food service, will be different than a service business. They're all a little different. But across the board, suffice it to say, profit margin should be positive, at least a positive number, not negative. There you go. And again, you want to know about your business, come in and see us. Well, I'll tell you what. Return on equity, net profit divided by owner's equity. This ratio measures the return of funds invested in the business by you. Okay. And the last one's called debt service. And a lot of loans are declined because you cannot meet debt service ratios. And what that is, principal plus interest payments on the loans divided by net profits. Remember I told you don't go zero profit? Yes, there you go. There you go. Okay. You've got to have enough profits to cover 1.25 times principal plus interest payments. So you got to have some profit showing to be able to borrow money to get a 1.25% on this ratio on debt service. Don't ever show zero profits if you can help it. Okay. Otherwise, don't borrow money. There's your other option. Just don't borrow money. Okay. In trend analysis, I always suggest that a client owns a business do this quarterly. Here's the ratios. Here's the name of them. Okay. There's a lot more that we didn't cover. There's accounts receivable turnover. How quickly do you recover the money you're billing? That's important. A lot of people that are up here in the North State work on the fires, right? You have a bulldozer, you got a water truck. Well, you bill for a fire, you may not be paid for 45, 60, 90 days, right? That's accounts receivable. That's sitting out there. That's money you've already spent, billed, and you don't have anything to show for it. You need to know how quickly that turns over, how quickly you collect it. And the same thing with inventory, right? If this pen sits on your in the back room and it's got dust on it, that indicates it's not a big mover, right? But these ratios on inventory turnover would tell you that this pen's not moving. See, you don't have to wait for the dust to accumulate. A lot of us just use the dust rule. Man, that thing's been there a long time. These ratios will help. And then you can do it quarterly. Okay. At the end of each quarter, check them. That's trend analysis. That's basically, if something's happening, correct it. If you can, fix it. That's very basically what it is. Okay. And remember, cash flow is not the same. Okay. Sources of cash flow, sales revenue, selling an asset, loan proceeds you've got in an investment in the business where you toss in cash. That's cash flow, not profit. Okay. Source of cash flow out, operating expense, purchase something, pay back on a loan, owner draw. So that's cash out. Cash in, okay. Operating profit, negative cash flow is not the same as operating loss. Remember that. Cash in the bank could or could not be positive cash flow, again. And cash flow management equals analyzing cash flow trends. If you have a lot of accounts receivable, cash flow can be really different, right? Because like I said, with the fire people that work the fires, they're not getting paid for 30, 60, 90 days from the event. Talk about cash flow. So you need to know that's going to happen. Okay. The 3 rules on cash flow management: plan, plan, plan. If you're a seasonal business, this happens quite often, I'm afraid. I have a customer that is out at the lake and they rent jet skis, tubes, all that stuff. Well, guess what? They make all their money Memorial Day to Labor Day. Not all, but most. Memorial Day to Labor Day. So their sales go whoop, doo, 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 and then they go whoop, and then they come whoop down the other end of the summer, and then they tail off into Christmas. Okay. Unless somebody's buying a gift certificate for next year's jet ski rental. Right. So guess what? They got to hide money. You got to hide money here to cover here. Hard to do, let me tell you. Right? It happens to these water truck people that I have. Water truck people, I'm rich, man, I'm rich. And then November comes, I have no more fires, they're not being hired. They still got the expenses to pay. You better hide some dough, man, when the fires are, when you're making all that money. Hide it, so when it's November, December, you can cover your expenses. By George, we did it in about the right amount of time. Kelly's gonna have, you got the survey, right, my dear?
Yes, I do.
And any other questions I can answer here at the end will be fabulous. Here's the poll.
Yeah, that'd be wonderful. So Karen wants to come back to the liability issue. She had an example of if she had internet for $100 a month and multiply by 12 months, is her current internet liability $1,200?
Perfect.
Great.
Perfect. Well,
So the poll has launched. Please take a moment to fill this out. And again, if you like today's webinar, by filling out the poll, we can continue having Joe tell us all this great information. Joe, can you go to the next slide?
Oh, I think I could. Where is it?
Yeah.
Oh, there we go.
Just reminding everyone that today's webinar was brought to you by the West Business Development Center. We offer free business advising for entrepreneurs and small businesses. So if you would like your free consultation, like Joe said earlier, please sign up to be our client by visiting our website at www.westcenter.org or calling our office. We are also a women's business center. As you can see, we have sites all over California if you are not local. And there are also other small business development centers all over California. So if you're not local, again, please find your local center, and they also offer free or low-cost business advising. So if you enjoyed today's webinar and would like to see more of our upcoming ones, please take a look at our workshop schedule on the website. You can also view past webinar recordings in our webinar library page, which you will find under the workshops tab. I want to thank everyone for coming today, and thank you, Joe, for a wonderful webinar. I hope everyone feels much more prepared for 2022. And I look forward to seeing everyone at another one of our upcoming events.
Wonderful. Thank you all very much. Happy New Year to everybody. And remember, we can help you decipher these numbers for your particular business once your 2021 numbers are solidified. Have a great day.
Thank you so much, everyone.